Forget the headlines. Ignore the fear. Right now, the Brent crude chart is revealing a secret the Pentagon and White House aren't sharing. While the world braces for a $25 billion market shock from a potential U.S. Israel-Iran conflict, price action remains surprisingly muted. We are trading at $111.12. Look closely at the structure. This is not a breakout. It's a trap. There's one danger zone above us and one hidden opportunity below that no one is watching. I'll show you both. Stay until the end, because I'm giving you 3 exact entry and exit levels you can use right now to turn this geopolitical volatility into profit. Whether prices spike or crash. Here's your immediate session verdict. The bias is a high momentum bull trend, but we are fading the noise, not chasing the breakout. This is officially a buy the dip session, but only at the right levels. The market is trending strongly across all time frames: weekly, daily, 5-hour, and 1-hour. Every signal screams strong buy, yet the RSI hasn't confirmed euphoria. We are in a consolidation phase. Write this number down. The invalidation level for this entire bullish structure is $104.71. If the market penetrates and closes below $104.71 on the daily time frame, the strong buy trend is structurally broken and will shift to a deep correction target. Until then, bears are walking on thin ice. Let's break down the charts from macro to micro scalping levels, because the alignment of moving averages here is one of the most aggressive I've seen in months. Zoom out to the weekly chart. This is your capital allocation roadmap. The long-term moving averages are sending a clear signal. The 50-week moving average sits at $103.26, while the 200-week moving average is far lower at $75.35. This massive separation tells us the long-term trend is structurally sound, but we are historically extended. The weekly MACD is printing a positive momentum histogram, robust, but not yet diverging. Buyers are pushing hard, but they're starting to show signs of fatigue. Now drop down to the daily chart, the battlefield of the last 24 hours. We have a critical confluence zone. The 20-day moving average has decisively crossed above the 50-day. The 20-day MA is at $107.17, and the 50-day MA is at $103.26. This golden cross acts as a dynamic support system. The 5-day EMA is sharp at $108.77. As long as we hold above this level, the market is flirting with an immediate acceleration. Daily resistance is clearly marked at $114.25, the top of the immediate range. Beyond that lies the breakout level at $116.41. Now zoom into the 4-hour and 60-minute charts. This is where the trap is set. The 4-hour MACD is showing a slight exhaustion signal, not a full negative divergence yet, but histogram bars are contracting as price grind higher. That's a message. The explosive momentum that drove us from $104 to $111 is stabilizing. The 4-hour 20-period moving average, sitting right at $108.77, is your intraday trend guide. If price breaks below this level, we won't collapse. We'll simply rotate back to the 4-hour 50-period moving average, which is exactly the zone we want to buy into. Now let's connect the technical structure to the fundamental fire. Headlines read: oil muted amid little progress in US-Iran talks, despite Trump delaying attack. This is the most critical sentence you'll hear today. Read it backwards. The market isn't muted because risk is gone. It's muted because the attack was delayed. That delay sucked the immediate panic premium out of the market, but it didn't eliminate the supply risk. This is a coiled spring. Every hour that passes without a deal pushes that geopolitical premium back into prices. Here's your crosser-set narrative. Watch gold right now. Gold is the architect of fear. If gold holds firm or rallies without a dollar collapse, it confirms the geopolitical bid is alive. If gold crashes while oil tries to rally on war fears, trust the bond market and the yellow metal, the oil rally will fade. The key correlation to watch is oil versus real yields. $111 oil creates a demand destruction ceiling. We are balancing the fear bid against the demand destruction gravity. The $25 billion war cost analysis isn't a fictional script. It's a liquidity drain on economic growth. If a strike happens, prices will spike violently, but that spike will likely be a fade unless the Strait of Hormuz is physically shut down to MY 1 to 2 week directional outlook. We'll grind higher to test $114.25, fail on the first attempt, trapping late longs, dip to rebalance around $108.40 to fill the fair value gap, then stage a sustained breakout if geopolitical tensions rise. The only event that invalidates this thesis is a confirmed, signed nuclear deal with Iran that would instantly drop the geopolitical floor by $8 to $10. Without that, every dip is a buying opportunity. Most people skip this section because they just want a prediction, but this is where money is made. Keep watching. I'm giving you 3 strategies: the sniper, the active trader, and the aggressor. Pay close attention to the stop losses. They're non-negotiable. Strategy 1, the sniper, conservative, high probability. This is the conservative play, focused on confirmation entries, no catching falling knives. You wait for the market to prove it respects the support zone. The trigger condition, a 4-hour close above the resistance turn support level of $108.77, and specifically, a wick rejection candle in the $108.40 to $108.70 zone. Enter a buy limit at $108.50. Place your stop loss at $104.60, just below the structural invalidation level of $104.71. Logic: if this level breaks, the trend is dead. Target 1, $111.50, a comfortable 3-to-1 risk-reward ratio. Target 2, $114, right below major resistance, a 5-to-1 setup. Void this trade if price tumbles through $108 without stopping. Don't catch the knife. Strategy 2, the active trader, standard engagement. This is for regular traders, leveraging the moving average bounce on the 60-minute chart. We have momentum, and we are waiting for a dip. Entry condition, a bounce off the intraday volume-weighted average price, VWAP, which currently aligns with the 60-minute 50-period moving average around $109.80 to $110. Enter a long position at $110.10. Place your stop loss at $108.70, just below the hourly swing low and the critical 60-minute moving average cluster. Reasoning: a break below this intraday support signals momentum is gone. Target 1, $112, current resistance pivot. Target 2, $113.50. Active rule: once target 1 is hit, immediately move your stop loss to your entry price. Turn it into a risk-free trade. This is how you compound gains without sweating Iran headlines. Let me pause. Let's gauge alignment in the room. Type your Brent crude range for the next 24 hours in the comments. Are you expecting a breakout above $114 or a dip below $108? I'll read them during the break. Strategy 3, the aggressor, high risk, counter trend, high risk, high reward. This is fading the top, betting on the trap. We know the 4-hour MACD is heavy, and the war premium is partially priced but not fully exploded. Entry condition, a false breakout above $114 on the 15-minute chart. If price pokes above $114 but the 15-minute candle closes back below $113.80, enter a short position immediately at $113.80. Place a tight stop loss at $114.45, above the spike high. Invalidation, a sustained 15-minute close above $114.50. This means the breakout is real, and you wrong. Target 1, a quick scalp to $112.50. Target 2, the mean reversion target of $111.20. Explicit warning: this is a counter-trend trade against a strong daily buy signal. You're picking up pennies in front of a steamroller, only for traders who know how to lose small and manage risk aggressively. Never risk more than 1 to 2% per trade. Avoid holding positions through high-impact news, like weekly crude inventory reports or unexpected Department of Defense, DoD, press releases. Stops are non-negotiable. If you can't honor your stop loss, You're not a trader. You're a gambler. Here's your survival guide for the next session. The single most critical level to tape to your screen is $108.40. Hold it, and we ride the bullish wave. Lose it, and the black gold narrative shifts to risk-off demand destruction. This is your line in the sand. Tomorrow, I'll be watching the S&P 500 liquidity closely. A collapse in risk assets will drag crude down faster than any OPEC headline. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen. Smash the like button if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage. I'll see you in the next one.